CoreWeave stock has already taken investors on a wild ride. But over the last few weeks, something very important has changed, and it's not another revenue number or backlog headline. Today I am going to show you 4 fresh signals that the market is sending about CoreWeave, a brand new $2 billion convertible debt deal. What the credit market is quietly pricing in as the chance of default. A $4 billion project finance joint venture in Pennsylvania that changes how CoreWeave funds new data centers, and how the Weights and Biases acquisition moves CoreWeave up the AI software stack. These are new developments you probably have not seen broken down in one place. If you want more than just hype, and you want to understand what the bond market and private credit investors are really saying about CoreWeave, stay with me. Not financial advice. Always do your own research. Let's start with the freshest headline. In early December, CoreWeave announced that it plans to issue $2 billion of convertible senior notes that will mature in 2031. There is also an option for the initial buyers to take up to an extra $300 million on top of that. So what does that actually mean? A convertible note is a type of bond. CoreWeave borrows cash today. It pays interest every year. But at some point in the future, the bond can be converted into shares of CoreWeave stock at a preset price. From CoreWeave's point of view, this is attractive because the interest rate is lower than on a regular junk bond. Recent reports suggest a coupon in the range of about 1.5% to 2%, which is far below the 9% CoreWeave had to pay on its unsecured notes earlier in the year. The company gets a lot of upfront cash to keep building AI infrastructure. From the shareholders' point of view, there are 2 big trade-offs. First, future dilution. If the stock does well, these bondholders can convert into equity and become new shareholders. Second, more leverage. CoreWeave already had about $14 billion of debt at the end of September. Adding another $2 billion of notes pushes that number even higher. CoreWeave also said it will use part of the proceeds to buy capped call options on its own stock. This is a way to reduce dilution for existing shareholders if the stock price goes up a lot in the future. So what is the signal here? To me, this says CoreWeave is still in aggressive build-out mode. Management believes it is worth taking on more debt today to grab AI demand while it is hot. But equity investors are becoming more sensitive to how the company raises money and how much future dilution could come with it. We saw that reaction immediately. The stock fell by roughly 5% on the day the deal was announced, as investors processed the new debt and the risk of future share issuance. Now, here's where things get really interesting. While equity investors argue on social media about whether CoreWeave is the next Nvidia or a bubble, the credit market is sending a very different message. One of the best tools to read that message is called a credit default swap, also known as a CDS. A credit default swap is basically insurance on a bond. If I buy CoreWeave bonds, and I am worried that CoreWeave might default, I can buy a CDS contract. I pay a yearly fee, and if the company defaults, the CDS seller compensates me. The higher the CDS price, the more worried the market is about default risk. Recent analysis of 5-year CoreWeave credit default swaps shows that the market is now implying roughly a 42% chance that CoreWeave will have some kind of default over the next 5 years, assuming a typical recovery rate. Let me repeat that slowly, because it is important. The equity story is about huge AI demand and growth. The credit story is that there is roughly a 4 in 10 chance of a default in the next 5 years. That does not mean CoreWeave is doomed, but it does mean that professional bond investors are pricing in a lot of risk. Why? Because CoreWeave's model is extremely capital intensive. Billions of dollars of data centers, billions of dollars of Nvidia GPUs and AI hardware, and now more and more debt layered on top with different maturities and structures. If everything goes right, that leverage amplifies the upside. If anything goes seriously wrong, like a delay in new projects, lower pricing, or a slowdown in AI demand, the same leverage amplifies the downside for both bondholders and shareholders. So the second big fresh signal is this. The bond market is no longer giving CoreWeave the benefit of the doubt. It is pricing in real default risk, even while revenue growth numbers are still strong. If you are a shareholder, it is worth watching these credit default swap spreads over time. When they tighten, the market is becoming more comfortable. When they widen, the market is getting nervous again. The next new piece of the puzzle is how CoreWeave is trying to change the way it funds new build-outs. In August and September, funds managed by Blue Owl Capital, together with Chirisa Technology Parks and Machine Investment Group, closed a $4 billion joint venture to finance CoreWeave's planned data center campus in Lancaster, Pennsylvania. Instead of CoreWeave owning every building and every megawatt of power directly on its own balance sheet, the idea here is different. The joint venture partners put up the capital to build out the campus. CoreWeave becomes a major tenant and customer of that campus. In simple terms, CoreWeave is saying, we still want the AI capacity, but we do not need to own every brick and every server rack ourselves. Why does this matter? Because it is a form of project finance. It can reduce CoreWeave's upfront capital expenditures for that site. It shifts part of the cost and part of the risk to private credit and infrastructure investors. In return, CoreWeave will likely commit to long-term leases or capacity agreements. The upside of this approach, it can help CoreWeave scale faster without putting every dollar of capex on its own balance sheet. It can free up some cash and debt capacity for other projects. But there are also risks. Long-term lease obligations still need to be paid, even in a weaker environment. CoreWeave is more dependent on external partners and on the local power grid being upgraded on time. For example, part of the Lancaster project includes hundreds of millions of dollars in grid upgrades and local infrastructure work, which requires coordination between developers, power utilities, and local authorities. So the third fresh signal is, CoreWeave is experimenting with a more asset-light style of growth by using big private credit partners and joint ventures, instead of funding everything entirely on its own. This could help the company move toward a more sustainable model, but it also increases the complexity of the overall capital structure. So far we have talked about debt and data centers. Now let's talk about software. In 2025, CoreWeave announced and then completed the acquisition of Weights and Biases, often written as W&B, which is one of the most widely used AI developer platforms in the world. If you're not familiar with it, Weights and Biases is a toolkit that AI teams use to track experiments, monitor training runs, log metrics, and manage models from idea to deployment. It is used by some very serious players, including organizations like OpenAI and Meta, according to multiple reports. Reports suggest that CoreWeave paid around $1.7 billion for this deal. Why would an AI infrastructure company spend that much on a software platform? Because it moves CoreWeave up the stack. Instead of just saying, here are some GPUs, rent them by the hour, CoreWeave can say, here is a full AI cloud platform. You get the GPUs, the storage, and the tools you already use to track, debug, and deploy your models. That has a few important implications. First, better margins. Software and platforms can carry higher margins than raw infrastructure. Second, stickier customers. If your entire training and experiment history is inside Weights and Biases, and that platform is tightly integrated with CoreWeave's cloud, it becomes harder to move your workloads somewhere else. Third, differentiation. There are many clouds offering GPUs now, but not many that combine Nvidia-heavy infrastructure with one of the leading MLOps platforms in a single stack. Of course, this is not free. It is more capital on top of all the data center spending. There is integration risk. Merging teams, products, and cultures always takes time. But as a fresh signal, the Weights and Biases deal tells us that CoreWeave is not content to remain just a GPU landlord. It wants to be seen as a full AI platform provider. Let's put this all together. In the past, the CoreWeave story was mostly about explosive growth and a huge pipeline of AI demand. Now we have 4 new and very important layers. Number 1. The $2 billion convertible notes due in 2031 show that CoreWeave is still willing to use creative financing to keep building quickly. Lower interest, but more complexity and future dilution risk. Number 2. The credit default swap market is pricing in a meaningful probability of default over the next 5 years. That is a loud warning from bond investors that leverage plus heavy spending is a very risky combination. Number 3. The Lancaster joint venture with Blue Owl, Chirisa, and Machine Investment Group shows that CoreWeave is willing to bring in external project finance to fund large campuses. That can reduce upfront capex, but replaces it with long-term lease and capacity commitments. Number 4. The Weights and Biases acquisition is about owning more of the AI software layer, not just the physical infrastructure. That could improve margins and customer stickiness if the integration works. So, is this all bullish or bearish? Honestly, it is both. On one hand, CoreWeave is building a very powerful position in AI infrastructure and tools. It is moving quickly, it is partnering with deep-pocketed private credit players, and it is trying to lock in developers at the software level. On the other hand, the debt load is heavy, the credit market is nervous, and every new financing deal adds another layer the company has to manage perfectly. If everything goes right, equity holders can be rewarded in a huge way. If something breaks, whether it is financing, power constraints, or a slowdown in AI spending, then the leverage makes the downside just as dramatic. As always, this video is not financial advice. My goal is to give you the fresh information behind the headlines so you can make better decisions for yourself. If you found this breakdown helpful, please consider liking the video, dropping a comment with your thoughts on CoreWeave's new debt strategy, and subscribing for more deep dives on AI infrastructure. Thanks for watching, and I will see you in the next one.